Ever found yourself trying to figure out what happens after a big property deal? Maybe you sold a house, inherited some land, or maybe a business asset got damaged. The money side, especially the tax part, can get pretty complicated. Welcome to the deep dive. Today, we're taking a shortcut through the, well, sometimes confusing world of property transactions and your taxes. We're going to try and clear up terms like non-taxable exchanges and tax-free transactions, make them make sense. Our mission, really, is to give you those aha moments so you know when you might be able to postpone recognizing a gain or loss, or maybe even avoid it altogether. We're pulling this straight from a solid guide on individual income taxes, just boiling it down to what you really need to know. And just quickly, when we say basis, think of that as your cost for tax purposes, what you paid plus improvements. And realize gain. That's your profit before we apply any special tax rules. Got it.
Yeah, and what's really interesting is how these rules, they might sound a bit niche,
Right.
tax code stuff, but they can make a huge difference in how you plan your finances. Whether you're investing, running a business, or just, selling your home, understanding this can really change things.
Okay, great. So let's jump into that first big one. What is the difference between a non-taxable exchange and a tax-free transaction? They sound so similar.
Yeah, they do, but the impact is totally different. It's a perfect starting point. So a non-taxable exchange, that means recognizing the gain or loss, is basically postponed, put on hold. Think
Yeah.
of it like hitting pause on the tax. Your original basis, your cost, it usually carries over to the new property you get, which means that gain or maybe loss, it's still there. It's just attached to the new asset waiting for later. But a tax-free transaction, that's different. The non-recognition of the gain is permanent. It's gone. And the basis of the new property you get, it doesn't depend on the old one's basis. The tax event just vanishes.
Okay, hang on. So non-taxable is like kicking the tax can down the road, right? It's
It's
still going to catch up eventually. But tax-free is like, poof. That specific gain is just gone, deleted from your tax worries. That sounds way better.
That's exactly it. That carryover basis in the non-taxable exchange is the key. The potential tax is still there, tied to the new property. You'll deal with it when you eventually sell that property in a taxable way. With tax-free, though, nope, gain's gone for good.
Understanding that difference postponed versus permanent is crucial for everything else we'll talk about.
Right. Got it. Okay, let's shift gears to something huge for investors, like kind exchanges. Section 131, this one gets talked about a lot, especially with real estate. Imagine you've got, say, a rental property. It's gone way up in value. You want to move that money into a bigger place, maybe, but that tax hit from selling, ouch.
Yeah, exactly. And Section 31 is the tool for that. But the first thing to really get is that it's mandatory non-recognition. If your deal meets the rules, you have to defer the gain or loss. It's not like you can choose to pay the tax now if you wanted to, not easily anyway. So planning ahead is really key. It lets you keep reinvesting your capital without taxes eating into it right away. Now, the requirements. There are three big ones. First, it has to be like-kind property. And this is critical. Since the law changed back in 2017, only real property qualifies. No more swapping machinery or collectibles under this rule. But for real estate, like-kind is actually pretty broad. You could swap, say, an office building for farmland or vacant land for an apartment complex. Generally, that works. Improved for unimproved, it's usually fine. Second, it has to be an actual exchange. You can't just sell property A and then later buy property B with the cash. It needs to be structured as a swap, often using an intermediary. And third, both properties, the one you give up and the one you get, must be used in a trade or business or held for investment. So you can't use this for your personal residence or your vacation home.
And if you're just flipping houses quickly, that's inventory. That won't work either. Intent matters. And it's just as important to know what doesn't qualify. We mentioned personal property is out. So we're stocks, bonds, partnership interests, inventory. Oh, and a really big one from our source material. You cannot exchange U.S. property for foreign property or vice versa.
Okay. So my dream of swapping my old Ford Pinto for a slightly newer one doesn't count. And like that Melissa example, she couldn't swap her rental building here in the U.S. for one over in Paris, France, right? Even if they were both rentals.
Precisely. That U.S. for French real estate swap fails the test. Any gain she had on that U.S. property would be taxed immediately. That's a key point for anyone thinking about international real estate. Now, about the exchange itself, people often think it has to happen all at once, like trading keys at the same table, but it doesn't. You can do a delayed exchange, but the timelines are super strict, non-negotiable. You've got 45 days from when you close the sale of your old property to formally identify potential replacement properties in writing. Then you have a total of 180 days from that same closing date to actually receive the replacement property. Or if it's earlier, the due date of your tax return for that year. Miss either deadline, even by a day, and the whole deferral is off. It becomes a taxable sale. Okay, let's talk about boot. Sounds weird, but it's important. Boot is basically anything in the exchange that isn't like kind property. Cash is the obvious one. But could also be debt relief, like if the other party takes over your mortgage. Or maybe they throw in some equipment that isn't real estate. Now, if you receive boot and you have a realized gain on the deal, you have to recognize some of that gain. You pay tax on the gain up to the value of the boot you received. It's the lesser the boot received, or your total realized gain. Like Khalid in our source example. He swapped a $50 K building for a $45K building plus $5 K cash. That $5,000 cash is boot. He'd have to recognize gain up to that $5,000 amount, assuming he had at least that much gain overall. What if you give boot? Like you add cash to the deal. Generally, that doesn't trigger gain for you on the like-kind property part. But there's a wrinkle. If the boot you give is appreciated property itself, say you throw in some stock you bought cheap that's now worth more, you do recognize the gain on that specific boot asset. So the gain recognition is tied to the appreciated non-like-kind asset you're giving up. But the good part, for the main like-kind property swap, the old property's basis, and importantly its holding period, they just roll over or carry over to the new property, that keeps the deferral intact for the main part of the exchange.
Wow. Okay. So thinking bigger picture here, this sounds incredibly powerful for real estate investors. You could potentially roll gains over and over, maybe for decades, without
Yeah.
paying tax immediately, compounding your investment without that tax drag. But it's mandatory, you said. Are there times when maybe you wouldn't want this? When deferring the gain isn't actually the best move?
That's a really sharp question. Yes, absolutely. Because it's mandatory, you might need to actively structure things to avoid Section 31 treatment sometimes. Why? Well, what if the property you're getting rid of has a loss? A like-kind exchange would force you to defer that loss too. You might want to recognize that loss now to offset other gains. Remember Ross in our source, he had land with a gain, but stock with a loss. Had to be careful. Maybe sell the land and buy the new land in separate transactions, not an exchange, to recognize the gain if you wanted to use that stock loss against it. Or make sure the stock sale was separate. Or maybe you have capital loss carryovers from past years just sitting there. Recognizing a gain now could let you soak up those old losses, basically clean up your tax situation. And, some people might look at current tax rates, especially the long-term capital gains rates, which max out at 20% currently, and think, rates might go up later. They might actually choose to trigger the gain now and pay tax at today's rates, rather than risk much higher rates down the road. It's all about strategy and forecasting.
Okay, that makes sense. Planning is key. Now, we've talked about intentional moves with investments, but life happens, right? Things you don't plan for, fires, floods, maybe the government wants your land. That brings us to involuntary conversions, code section UN033. This must be a really important safety net.
It really is. An involuntary conversion happens when your property is, say, destroyed in a fire, stolen, seized, condemned by the government, or even if you sell it under the threat of condemnation. If you get money from this, like an insurance payout or a condemnation award, and it's more than your basis, you have a realized gain. Section 103D3 lets you postpone that gain if you reinvest the proceeds into qualifying replacement property within a specific time frame. If you reinvest everything you got, the whole gain can be postponed. If you reinvest less, well, you recognize gain only on the difference of the part you didn't reinvest. But here's a critical point. Section 233 is only for gains. If the involuntary conversion results in a loss, you follow the normal loss rules. So if your business warehouse burns down and insurance doesn't cover your basis, you generally recognize that loss. But if your personal home is condemned and you get less than your basis, that loss is usually not deductible because it's personal use property. Now, the replacement property, it generally has to be similar or related in service or use to the old property. This is usually stricter than the like-kind test for Section 231. There are two main ways to look at it. If you're an owner-investor, like you leased out the property, it's the taxpayer use test. The new property has to be used by you in a similar way, like replacing a leased warehouse with a leased apartment building, similar endeavor for you, the owner. But if you're an owner-user, using the property yourself in your business, that's the functional use test. Much stricter. Your use of both properties has to be the same. Replace your factory with another factory, not an office building. However, there's a special helpful rule just for condemnations of business or investment real estate. In that specific case, you get to use the broader like-kind 671 standard for replacement property. Much more flexible. Like Erica's factory in our source, it was condemned. She could replace it with investment land and still defer the gain under this special rule. That wouldn't fly under the normal similar use test. Time limits are important here too. Generally, you have 2 years to replace the property, starting from the end of the tax year you first realize any gain. But for those condemnations of business or investment real estate, you get 3 years. A bit more breathing room. And another key difference from Section 2031, When the conversion is into money, like insurance cash, which is most common, choosing non-recognition is usually elective. You have to choose to postpone the gain by reinvesting and recording it properly on your tax return. If you don't elect it or don't reinvest in time, you recognize the gain.
Okay, elective. That's interesting. So similar to the Section 31 planning, when might someone choose to recognize the gain from an involuntary conversion?
Yeah.
Say their building burned down, they got a big insurance check. Why not defer?
Yeah, it's that same strategic thinking again. Maybe they have big capital losses sitting around that they want to use up now.
Yeah.
Burning off those losses against the gain might be smart. Or, again, maybe they think tax rates are going up significantly. Paying tax now at potentially lower rates could be better than deferring it to a higher tax future. Look at Martha in the source material. Her warehouse is condemned. Big gain of $180,000. She wants to defer it by buying an office building to lease out. Because it's a condemnation of business real estate, she gets that flexible like-kind replacement standard. And crucially, even if she sold it to a broker because the city threatened condemnation, it still counts. She can negotiate the best deal while preserving her ability to defer that large gain. The elective part gives her control.
Right. That makes a lot of sense. Okay, let's shift from business and investments to something that hits, well, pretty close to home for most people.
Yeah.
Selling your actual home, your principal residence. I think a lot of people know there's a benefit here, but maybe not the details. You can potentially sell your home and pay zero tax on a lot of the profit.
Absolutely. This is Section 121. It's a huge benefit for homeowners. First off, just to reiterate, if you sell your personal home at a loss, that loss is not deductible. It's considered personal, no tax break there. But if you sell it at a gain, you can potentially exclude a big chunk of it from your income permanently. Up to $250,000 of gain if you're single, or up to $500,000 if you're married filing jointly. And this is an exclusion, remember, not just a deferral. The gain vanishes for tax purposes. Now, there are strings attached, of course. The main requirements. During the 5 years leading up to the sale date, you need to have owned the home for at least 2 years. And you need to have used it as your principal residence for at least 2 years. Doesn't have to be continuous, just add up the time. Short breaks like vacations usually count as use. And a big one to prevent abuse. You can generally only claim this exclusion once every 2 years. For married couples aiming for that $500,000 exclusion, one spouse needs to meet the ownership test, but both spouses need to meet the use test. And neither spouse can have used the exclusion on another home sale within the previous 2 years. There's also a helpful rule for surviving spouses. They can still use the full $500,000 limit for up to 2 years after their spouse passes away, provided they meet the other rules. It offers some relief during a tough time.
Okay, the 2-year ownership and use tests, and the once every 2 years rule. That seems designed to make sure it's really your home, not just a quick flip. But what if life throws a curveball? You know, you get a new job far away, or someone gets sick and you have to sell before hitting that 2-year mark.
Great question, and the law actually anticipates that. There are important exceptions that allow for a partial exclusion, even if you don't meet the full 2-year requirements due to unforeseen circumstances. A change in place of employment is a big one. If your new job location is at least 50 miles further from the home you sold than your old job was, that can qualify you. Health reasons also count if a doctor recommends a move for health reasons for you or a family member. And then there's a catch-all category for other unforeseen circumstances. The IRS gives examples like the home being destroyed or condemned, tying back to involuntary conversions, a death in the family, losing your job, divorce, even having multiple births from one pregnancy, things that genuinely force a move. If one of these exceptions applies, you don't get the full exclusion, but you get a partial one. It's prorated. You basically calculate the fraction of the 2 years, or 24 months, you did meet the requirements. Say you lived there 18 months before a qualifying move. You'd get 1,824ths, or 3/4 of the full exclusion amount, $250K or $500K. And just to hammer this home, this is an exclusion, not a referral like Section 3.
So the basis of the next home you buy is just whatever you pay for it. There's no adjustment carrying over gain from the old home because that gain was permanently excluded. One quick note though. If you use part of your home for business, maybe a home office or rented out a room, and you claim depreciation deductions on that part, well, the gain attributable to that depreciation doesn't get excluded. You have to recapture that depreciation as taxable income when you sell. The IRS wants that tax benefit back.
That Section 121 exclusion is just fantastic for homeowners. It really makes a difference in building equity and, having flexibility later in life, like when downsizing for retirement. Planning around this seems crucial.
It absolutely is. And it leads to interesting planning questions, doesn't it?
Mm-hmm.
Especially if someone owns more than one home. Think about it. Maybe you have a city apartment and a country house.
With careful planning, making sure you meet the 2-year ownership and use tests for one, then maybe later the other, you could potentially exclude gains on multiple properties over your lifetime. It requires carefully documenting which one is your principal residence and for how long, but it's a powerful strategy allowed by the rules.
We've definitely covered some ground today, from like-kind exchanges for investors to involuntary conversions when disaster strikes, and now the big home sale exclusion. Let's try and boil down some key planning takeaways.
Okay, let's summarize. Like-kind exchanges, Section 031. Remember, mandatory deferral for real estate held for business or investment. Key takeaway. Sometimes you might want to recognize a loss or use carryovers, so maybe structure the deal to avoid Section 031. Think before you swap. Involuntary conversions, Section 033. Generally elective for gains when you get cash. Gives you a choice. Postpone the gain by reinvesting, or recognize it now if that fits your tax picture better. Using losses, anticipating higher future rates. You have control. Sale of principal residence, Section 121. That huge exclusion, $250K, $500K, is automatic if you qualify, but technically you can elect out of it, though that's rare. The real planning is ensuring you meet the ownership as tests, potentially on different properties over time if you own more than one. And remember those prorated exceptions for unforeseen moves.
It really hammers home that understanding these rules isn't just about filling out tax forms correctly, it's about active financial strategy.
Exactly right. You need to think critically about your specific situation, your goals, and apply this knowledge strategically to really make it work for you.
So here's something to think about after we wrap up. How does really grasping the difference between postponing a tax versus permanently excluding it change how you might approach long-term decisions about your assets? Not just the big ones, but even how you react to unexpected events. Thank you for diving deep with us today. We hope you feel a bit more confident navigating the world of property transactions and taxes. We'll catch you on the next deep dive.